Hi, everybody. Welcome to Monday Masters. Today's guest is Andre Coakley with Credit360. Hey, Andre, thank you for coming on, man. How you doing?
Hey, how you doing, Mark? I appreciate you inviting me out to Monday Masters. You know, I enjoy everything you guys are doing. We follow it, and I keep pushing. I appreciate it.
Good. Listen, no worries. So, for the past couple of weeks now, we've been talking about what homeowners need to do to really prepare themselves for that homeownership process. So, we've talked about pay stubs, other income sources, tax returns, and insurance. So I really want to have you on board today to talk a little bit about credit and what homeowners need to do to prepare themselves for credit. So as a first-time home buyer, what would be a couple suggestions that you would make to be able to help them prepare?
Well, the first thing I'm always going to say is pay your bills on time. That's going to be the first thing, right? And it sounds a little bit, cliche-ish. However, it's something that's very serious because a lot of times you don't realize how, a late payment here, a late payment there can really kind of bring down credit scores. Now, on the flip side, just because you pay the bills on time doesn't mean you're going to have a high credit score as well. So paying the bills is just a portion of your credit score, which equates to roughly about 193 points of just paying the bills on time. However, when we look at the credit scores, the highest credit score is at 850. The lowest credit score is a 300. So you have 550 points in between. Of those 550 points, roughly, give or take, roughly 193 of those points are just predicated off of payment history. So the first thing we want to say is make sure you pay your bills on time. And the payment history category is allocated in 30-day increments. So let's say you have a payment that's due January 1st. However, you don't make that payment on January 1st. On the 15th of the month, the actual creditor or lender assesses a late fee, and then you pay it on the 17th. If that's the case, even though you pay the late fee, it's not going to show late on the credit report until it flips over to a 30-day period. So the scenario where we show late, let's say hypothetically you have a payment that's due January 1st. On the 15th, they assess the late fee, all right? However, you pay it on February 1st, that's going to be considered a late payment on the credit report. However, the first scenario would not be considered a late payment. And that's just one of the things I like to tell first-time home buyers, because a lot of times when they get assessed that late fee, they give up because they think it's going to be reporting on the credit report as late.
Okay, fair enough. I've had a lot of clients that have asked me, Mark, my credit score on Credit Karma or Experience site was this. Why is it so different from you when you as a lender are pulling the credit score? And should I really trust Credit Karma and those sites to get an accurate picture of my credit score? What's your thought on that?
Well, it's a twofold, right? It's a two-step process, or multiple steps, or multiple different angles from it. Number one, when you run an individual's credit report, you're running it under a FICO version or a FICO algorithm-based credit score, which FICO is a scoring model. FICO, F-I-C-O, which is the Fair Isaac Corporation, is pretty much a mathematical equation that all three credit bureaus purchase to equate a credit score for individuals. Now, most of lending, 90% of lending, goes by the FICO score. However, you have Credit Karma or these credit monitoring apps. They use what we call a Vantage version of your credit score, which is a totally different arithmetic, all right? The FICO version has 5 categories. The Vantage version has 6 categories. So it's looking at you from a totally different perspective. Per se, if I were to actually put my glasses on and look at a credit report versus putting someone else's glasses on and look at the credit report, I'm still going to be able to see the information. However, it's going to be a little bit skewed because we're looking at it from totally 2 different lenses.
Got it.
All right. However, just on the caveat with Credit Karma makes anywhere between $5 to $15 every time we apply for a credit card, and anywhere between $25 to $75 every time we're approved for a credit card. So Credit Karma made $500 million last year. As far as I know, say it again.
There's a benefit there, right?
There's a benefit. As far as I know, I've never cut Credit Karma a check. I've never paid for anything. So therefore, we know you work for who pays you, right? So who are the people who pay Credit Karma? You have all these lending institutions, Capital One, Chase, Bank of America, car lending institutions, personal loan institutions, insurance products. Any product that's being sold to you on Credit Karma is getting a piece of that pie. And that's the reason why they actually play with your credit scores. If you notice, your Credit Karma credit scores will fluctuate quite drastically. What they're doing is they're creating consumer engagement. When a window is opening and closing, as a consumer, when it's open, we lean in a little bit more because we know it's going to close again. So if they know that your credit scores are going up and down, and they're actually playing with those algorithms, they know that one day it's going to say your chances to get approved for this credit card are fair. And then the next day when they push those credit scores up, it's going to say that the chances are good. Now that creates consumer reaction where now you apply for that credit card because last week, you know, it said the chances were fair. However, this week, Credit Karma suggests that it's a good opportunity for you to apply for. However, when you apply for that credit card, you can still be denied. Credit Karma cannot make that relationship. They're just the middleman, right? They're just passing over. I'm sorry?
There's no guarantee, right?
There's no guarantee whatsoever. So we have to be very careful with that because they revenue by you applying for that credit card, whether you get approved or not.
Okay, good. And so what are you seeing on a national level as it relates to credit scores and the average credit score that folks should be trying to achieve? What are you seeing on a national level?
Well, of course, on the national level, I'm going to say you should be trying to achieve the highest credit score possible, period, regardless to where you sit geographically. The whole idea is to minimize risk. But what we've noticed is we have to kind of be careful because the pandemic has had a few people living off credit cards, right? Yeah. So that credit card usage, unfortunately, is now trending credit scores in some aspect possibly down for the simple fact now the utilization aspect of the credit card is going up. So when banks see that individuals are possibly borrowing money on their credit cards, that affects the utilization, which affects the risk, therefore it possibly reduce the credit score. However, what we have seen is an increase in home ownership as well, right? I'm pretty sure, you know, things are, right? So there are most definitely individuals out there who are taking advantage of the low rates that are available.
Yes.
I believe with your platforms, the minimum credit score is required, or at least the 620.
Correct. And I'm glad you mentioned that. You know, we can look at credit scores of 580 and higher, but really, since, you know, my expertise has always been the DPA, the down payment assistance. So release for the down payment assistance, we're really looking at credit scores of 620 or higher. But yes, you're right.
Right, exactly. So again, I'm not trying to tell you to aim. So just to put this in perspective, a 620 credit score is the equivalent to a C- in school. All right. So I would never send my son to school and say, son, just bring me home a C-. So I don't want you to aim for the 620. We just know that's the barometer in order for you to get to the next grade level.
Yes, love that.
All right. So make sure that you aim high. Credit scores are fickle. You can have a great credit score today, have a little hiccup tomorrow, apply for a credit card, utilize a credit card, or something can pop up on the report and it can affect the credit scores. So do everything you can. I also tell homeowners, potential homeowners, you should be monitoring your credit report every month.
Okay, great.
All right.
So getting in contact with your team, and how many people do you have on your team right now that are helping individuals out there in the market repair their credit and kind of work on their score? How many folks do you have?
10. It's 10 of us.
10 of you. Fantastic. So listen, I want to thank you, man. Tell me a little bit about your book that you have out there. Yes.
Yeah. Let me not on mine. Let me just get my little plug in right here, right?
All right.
All right. Attempt to Repair America's Broken Credit System. It's a book I wrote for individuals just like yourself who are looking to find ways to repair their credit on their own or get some of the strategies. Now, keep in mind, I repair credit for a living, right? So I'm actually the one repairing the credit. However, if you don't have the skill set and the mindset and the aptitude to handle yourself out there in public, you're going to be right back in my office. Don't get me wrong. I love my clients, but I don't love them like that, right? The whole idea is to, get you back on track and give you your blessings. Make sure that you understand how to navigate out there in the credit world. And I don't want to see you again unless we're just talking about, why is your credit score, an 800 and not an 850, right?
Exactly. Love it. So listen, Andre, thank you again. Andre Coakley, folks, with Credit360. And once again, brother, it was a pleasure to talk to you, and keep up the great work, and we'll talk soon again, okay? Be good.
No, thank you guys. Appreciate it.